If you've checked your portfolio recently, you might feel a little panicked. Big red numbers, sharp declines is enough to make anyone want to hit that sell button. But before you do, let's talk about what's really happening. Anyone who's looked at the news recently will notice that there's a lot of fear about the economy. New tariffs against Canada, Mexico, and China, layoffs across the government and private sector, and fear about increasing prices for everyday things have dampened consumers' outlook on the economy. In fact, companies like Target have warned that if consumers cut back, it would hurt their profits. Perhaps most notable for folks is how the stock market is performing. Regular 500-point declines in the Dow Jones Industrial Average Index can make anyone nervous. The question is, should you be too? In today's episode, I'm going to discuss the recent decline in the stock market, decisions that people are making, and what you should do instead. And if you're new here, click the subscribe button for more money tips. The stock market is in free fall. Why? First, let's clear something up. The stock market and the economy are not the same thing. Yes, they can move together during recessions, but the stock market is a lot more volatile and reactive than economic figures suggest. The stock market reflects the accumulated values of publicly traded companies like Google, Apple, and Nvidia. These values are determined by investors who assess company worth based on financial performance, market trends, and yes, even sometimes rumors. Investors want to buy stocks that have strong future potential, whether it's profitability, market share, or innovation. But more importantly, they want stocks they believe other investors will want in the future. When we see big swings in the stock market, it's not just about the economy. News like tariffs, trade wars, and unemployment reports can create ripple effects that alter company valuations. For example, if new tariffs don't directly impact Nvidia's profits, they might make investors feel less confident about its future, causing the stock price to drop. So what are investors thinking? People tend to react in two main ways. First, they sell everything and wait to buy back in. I fell into this trap during Trump's first term. Back then, tariffs led to trade wars, and I sold nearly half of my S&P 500 index fund holdings and shifted them into government bonds. The problem? The market rebounded faster than I expected, and I missed out on big gains. If you sell now, how will you know when to get back in? What if you wait too long and miss the recovery? Even professional investors get this wrong. Many firms pulled out of the market after the 2008 financial crisis, only to miss out on one of the longest bull runs in history. If the pros can't time the market, neither can we. Second is diversifying outside the United States. The S&P 500 is made up of the largest US companies, but there are global index funds too. Recently, international stocks have outperformed. So far this year, they've grown over 7%, while the S&P has fallen nearly 2%. This can be due to many reasons, such as changes in the value of the dollar, confidence in the American economy, interest rates, and company valuations due to recent policies. Does this mean that you should sell US stocks and buy international? Not necessarily. Historically, the S&P 500 has outpaced international markets. Over the past 10 years, it's been up 176% versus 28% for international stocks. Instead of selling, consider putting new investment dollars into international index funds like VXUS, while continuing to buy the S&P 500 index fund. Over time, this increases diversification without locking in losses. What should you do? Here's some simple advice when it feels like the market is crashing. First, do nothing. Change the password to your investment account and forget it. The more you check your portfolio, the more likely you are to make emotional decisions. Think of your investments like baking. If you open the oven and mess around with it, you'll ruin the process. Let time do its thing. The market has recovered from every past crash. The dot-com bubble, the 2008 financial crisis, the COVID crash, and the 2022 inflation spike. The question isn't if it will recover, but whether you have the discipline to ride it out. Second, keep investing. Stocks are on sale. Imagine seeing an iPhone that used to cost $1,000, now selling for $700. Would you buy it? Investing when stocks are down is no different. When you consistently buy stocks, no matter how the market is performing, this is called dollar cost averaging. This system works because time and time again allows you to buy when the market is low and benefit when it recovers. So keep buying through the downturn. When the market rebounds, you'll be glad that you did. Third, diversify. If all your investments are in American stocks, consider adding international exposure. This should be part of your strategy regardless of how the market is performing. A well-diversified portfolio includes US stocks, international stocks, and bonds. I personally invest in a 2055 target date index fund because it gives me exposure to all three of these markets automatically. Investing right now can feel scary, but emotions shouldn't drive financial decisions. Selling too early or chasing returns can set you back years. Focus on your long-term goal, whether it's retirement or saving for your child's education, and trust that your investments will work for you, as long as you stay consistent. And let me know in the comments, are you feeling nervous about the market or are you staying the course? I'd love to hear how you're thinking about your investments right now. If you need help creating an investment plan, including how much you should invest to save for your future goals, check out my free life cycle calculator and worksheet at www.lifecyclepf.com. And if you want personalized help with your plan, check out the working page on my website. Markets go up and markets go down. But the best thing you can do is stay the course. Your money is working for you, so don't let fear pull you off track. Remember, the biggest investing mistake isn't losing money, is letting fear stop you from building wealth. And of course, life is lived outside your wallet. Cheers. And now a word from our sponsor.